Welcome back to Financial Focus Radio. Thanks for joining us on this a little bit less smoky weekend. Hopefully we get a little more rain next week and more of these fires get extinguished. In this segment, we're going to talk about the Fed and the 3-year tailwind they just gave stocks and asset prices in general. But before we talk about that, since the election is upcoming and a lot of you feel the need to make some maybe binary decision about investing all in or all out based on who you think is going to win or not win the election and the volatility that will be created around maybe a potentially contested election, all the things that could play out in November. Hopefully it all goes smoothly and we know who's going to be the president on November 4th. That's what we can all wish for. No matter who it's going to be, I think we all want the election outcome to be decisive and not create a lot of problems after that. But so the idea that you can somehow time markets, we talked earlier in the show, most market volatility events like we saw in the month of March of this year, if I told you on March 23rd, if I came to any one of you or if I came to you, Josh, or even myself, and I said, today, March 23rd, is the bottom of this correction, all of you would have said I was crazy. I would have said I was crazy because if you think back to that period, all the things that could continue to go wrong. We had, the economy essentially shutting down around the world. The flights were stopped. All of these things were happening, and yet markets bounced, and now we're 50% higher than we were on that date. And I use that as an example. As you think you can time markets. You say, okay, well, I'll get out now, and then I'll get out once we get some certainty. But none of that might happen, and markets might continue to rage higher. And so I thought I'd share with you some data about missing days in markets, because we all know that time in the market is the most important thing, not trying to time the market. And so if you look at the S&P 500 going back 20 years, ended on December 31st of last year. So from the year 2000 to the end of 2019, in the S&P 500, if you invested $10,000 in the S&P on December 31st of 2000 and you missed just the 30 best trading days, so 30 trading days in 20 years, your $10,000 would be $6,700. So your return is negative. If you missed the 20 best trading days, your return is barely positive. It's $10,167. If you just missed 10 days in a 20-year period, your return is only $16,180. And if you stayed fully invested, your money is $32,421. So double if you just missed 10 days by staying fully invested.
Well, and of all those people that I've talked to that correctly actually timed the sell decision in the latter half of February.
It's the worst thing in the world for them.
None of them successfully reinvested.
Well, and let's say you got is Buffett. When I used to go to the Berkshire Hathaway meeting and they talked about their investment managers, if their investment managers perfectly timed the sell-off in 2008, 2009, if they perfectly got that right, they sold at the top, bought at the bottom, they would have fired them because it would have been pure luck and it would have reinforced to them that they could do that successfully in the future. There is not a person on the planet that can successfully time markets. Before we talk about the Fed's long runway that they just created, I thought we'd talk about the Fed's mortgage buying spree is now at $1 trillion, and it doesn't look like there's an end in sight. The central bank now owns 30% of outstanding agency mortgage bonds. So an agency mortgage bond is a bond that was owned by Freddie or Fannie, Freddie Mac or Fannie Mae. Those are agency loans. The Fed is buying those things hand over fist, which is another reason the mortgage market and the housing market is on fuego.
The FOMC statement on Wednesday, they're committed to buying another $40 billion a month in perpetuity.
Which is just crazy. So let's talk about the Fed and let's talk about what the Fed said last week and what that means for asset prices and what that might mean for your asset allocation. We've rethought maybe what it means to be an asset allocator in this world and to invest money for retail investors. So the Fed had their FOMC meeting last week, and the chairman of the Fed came out last week with the notes and said essentially that they're not going to raise rates or even think about raising rates anytime in the next 3 years, at least through the end of 2023. And so what does that mean? Well, they're also, not only are they buying, are they keeping interest rates low, but they're buying bonds, high yield corporate all the agency bonds in the market, which has the effect of keeping rates low. So they are doing everything in their power to keep interest rates low. So what does low interest rate mean for asset prices? It means that asset prices can have much higher valuations. So that the normal valuation metrics that we think of in the stock market and the housing market, you can increase the valuation amount, but not to the level that we're starting to see.
Well, most simply, it just means that cash in the future is worth more because you're discounting it by less.
Right, but the more the cash today is worth essentially nothing.
Yeah.
So the problem that the Fed has created for most all of you out there listening, for people that do what we do, is any fixed investment, whether it's cash or you look in the bond market, you're going to get next to nothing. You're going to get negative real yield in your portfolio from the bond side of your portfolio. So what does that mean? That means that you have to have a higher equity exposure. And the Fed has said we're going to support equity prices, asset prices, for at least the next 3 years.
They're implicitly saying that they want to disincentivize saving.
Yeah, they are flat out saying, we want you to buy.
We can argue about whether it's implicit or explicit.
We want you, if you know what they're, we can be their spokesperson. How about that? They are saying, all you savers, too bad. We want you to move all of your savings out of savings and CDs and treasuries and corporate bonds, and we want you to buy stocks, and we want you to buy houses and commercial real estate. We want you to buy risk assets because we are going to penalize you for owning safe assets, and we are going to reward you for at least the next 3 years for owning risk assets.
And this is a grand experiment in whether or not the wealth effect can simulate consumer spending to a degree that will create enough aggregate demand to stimulate growth and thereby enable them to lower or to raise interest rates down the road.
Right. And so the idea, it's the wealth effect will create inflation is what you're trying to say. And the thing is if somebody like me, my net worth increases by $100,000 because of the wealth effect, it doesn't change my behavior at all. So there's no velocity of money. There's no inflation created in the system. It's the lower end.
And that effect is magnified by the people that are truly benefiting from this. The Mark Benioffs and
if you have $50, $100 million, it's magnified to a huge degree. So if you have a huge portfolio of real estate, or if you have a huge portfolio of stocks or any risk asset, that effect is magnified. Let's say your net worth goes from $50 million to $75 million. That person's behavior doesn't change. The person's behavior that changes is the person on the lower end of the income spectrum. But what the Fed is doing has no impact on those people's life because they can't afford to buy stocks because they don't have any extra money, and they can't afford to buy houses because the house prices have run away. And so, but our point in telling you this is I think most people are going to have a higher allocation to risk assets to achieve their goals in retirement.
And accept the volatility that's going to be inherent in that allocation. You don't really honestly have a choice.
Right. Your options are negative real return in bonds or any safe assets, or higher returns backed by the Federal Reserve, but with more volatility around that.
In the circumstance we talked about earlier where, interest rates conceivably go negative, there may be a bit more price appreciation there, but, it's not going to be sufficient to really generate positive return.
Yeah, but that's a game that's eventually going to end. And so that's not a game that you want to be playing. And so what it means, though, from an equity standpoint is yes, let's say you're normally a 60-40 portfolio. You might have to have 75% in stocks instead of 60% in stocks in order to achieve what you need in retirement. But our urging for you would be that you do it in not all U.S. large cap, is that you do it in a truly globally diversified portfolio that includes asset classes that are non-correlated. Yes, you have to own risk assets, but make sure you own small cap, mid cap, large cap, international, emerging markets, value, all of the different asset classes.
This average inflation targeting strategy that they're going after, which presumably means that they're going to let inflation run over 2% for quite a while, if they can ever get there. They undertook a reassessment of this last year is when they sort of began this, and pity Jay Powell, he got dealt a pretty bad hand on this whole one, and so. You smirk.
Well, he wants the job.
Yeah, of course he wants the job. But, this was something that they've been thinking about for a while. This just precipitated it.
I would argue that this started with Alan Greenspan a long time ago.
Fair enough,
So.
yeah.
All right, if you want to be part of the show, give us a call, 877-670-7117, or go to our website, financialfocusradio.com. When we come back, we'll tag you some of your email questions.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.